Hi class, welcome to Chapter 2 of Mutual Funds. Today we're going to discuss a brief history of mutual funds. Most of the items here we're going to talk about are mostly trivia. Not too many slides here, so I'm going to try to go through this fairly quickly. Okay. A little history. Pooled investment vehicles have been on record since the early 1800s. Before World War I, the U.S. was not a financial power. That kind of happened because Europe got crushed during World War I and they were rebuilding and we were already here, so we were kind of the beneficiary of that. The boom years brought many Americans into the markets, which were largely unregulated at the time compared to today. The Depression, on the other hand, drove people away from the markets because there was little regulation and a lot of people were getting ripped off, which was part of the cause of the Great Depression. Right? People lost confidence in the markets. When people lose confidence in the markets, credit stops flowing. A little bit on shapers of the industry. Article talked about in the chapter. Ned Johnson, he founded Fidelity Investments, which is still a private company. Started one of the first open-ended mutual funds. Is credited from transforming the mutual fund industry from a product to a service. Okay. Before he took over, or started Fidelity, you know, mutual funds were looked at as just an investment. You buy a mutual fund, you hold on to it, you sell it, whatever. He tried to offer the consumer a service, more information, better service. Why? Well, because that's what's going to bring people back. And I mean, at the end of the day, if you have a mutual fund in the S&P 500, it's not going to, and it's a passive investment, it's not going to be all that different from any other company offering an S&P 500 mutual fund. So you might want to differentiate yourself by having better service, Think of it like a pizza restaurant, right? If the pizza's the same at every restaurant, which one are you going to go to? The one with the best service, right? Okay. Explosive growth in the 80s and 90s, looked at as a way for a modest investor to get professional management. So mutual funds, most mutual funds are actively managed, meaning the person, the investment advisor, is managing your assets based on a benchmark, like the S&P 500 or the Russell or the Wilshire Index or the MSCI Index. They're managing them against an index as a benchmark for comparison, but they're actually making active bets on the market in order to what? Make more money for you. And by making more money for you, they will in turn make more money for themselves because they get, at the very least, a management fee, which is based on the portion of the assets. Taking a little quick sidetrack from this slide, the mutual fund business is a fee-based industry, and it's one of those businesses where they say, rising tides raise all boats. So the stock market is doing really well. All else being equal, you're going to have higher assets in your fund, which will in turn cause your 1% fee to generate more revenue, right? Because it's 1% of whatever you're holding. So if the stock market is doing well, then it's easier to be a more successful investment manager. Okay. What else helped fuel the growth of the mutual fund industry? The ERISA Act of 1974. Should be able to tell me a little bit about that for a quiz. The ERISA Act of 1974 basically established the guidelines for the creation of what we know today as a 401k account, right? Before 401ks, everything was more along the lines of pensions, so there was less need for diversification among mutual funds. With many different individual retirement plans, there's more room for many different mutual fund advisors, okay? In the 80s, Americans had more money to invest for retirement, spurring industry growth. Okay. Until the 1970s, there was only load funds sold through broker-dealers who received commission on transactions, and no load funds sold directly to the public by the management company. So, if you're going through a broker, the broker needs an incentive to sell the security. Okay? The broker will provide service to you, maybe educate you on the product, steer you in the right direction. So these fees, these load fees you pay, go towards the service you're getting, right? If you buy directly through the management company, then guess what? They're not going to give you any real advice on the product because they just want you to buy their product, right? You know, comparing it to something, I always you'll see me compare stuff to retail things all the time. So, for example, you go to Best Buy and get a computer, right? They have let's say 5 or 10 different brands of computers, right? They don't really have an incentive to necessarily push you to one or the other. They might try to fit you better into one of their products compared to, let's say, you go to an Apple store. You know, you're buying direct through the Apple store, right? So they just want you to buy an Apple. They might not even educate you on other products in the market. Why? Because they're only trying to get you to buy their product. In 1979, the 12B1 changed. In 1979, Rule 12B1 changed this by allowing funds to charge investors for distribution costs. Now, this is very controversial. They changed the law over the last year, or they are changing it. Basically, they started having no-load funds. But no-load funds were charged a continual management fee, which was only for distribution of the funds, which was another term for marketing. So these 12B1 fees would be used to pay the brokers, right? And that way, the brokers had incentive to keep you invested in a certain fund, right? Because they got a portion of that continual fee, okay? So we'll discuss this in a future chapter, but there's front-end loads on a fund and back-end loads on a fund. Regardless of whether the fees are charged up front or on the back end, they cut into performance, right? Back-end loads a lot of times will decrease over time. So they'll have an agreement that says, all right, if you sell your fund within 1 year, we're going to have a 3% fee. But if you keep your fund for over 5 years, we won't charge you any fee at all, right? Product development. How do mutual funds advance? Mutual funds are tremendously diversified. You can go look online and find a mutual fund for just about any segment of the market, any region, any sector, any industry, leveraged, inverse. And why is this? Because, how many, like I said a few minutes ago, how many different S&P 500 plain vanilla mutual funds can you have? You can only have a handful, because after that, the space in the market for that is going to run out. You're going to need to have, create something specified. Like, all right, well, instead of the S&P 500 plain vanilla mutual fund, we're going to have a S&P 500 energy index mutual fund, and then we'll have a industrials index mutual fund, and then we'll have, so on and so forth. And then we have all the foreign countries, and we could have a Chilean commodity mutual fund, that focuses on Chilean commodity companies, that does, stuff like mining. So you can see why these new products advance, and etc. Okay. In 2000, there was more money invested in mutual funds than ever before. September 11, 2001, along with the scandals of Enron, WorldCom, and HealthSouth, changed the industry. People were a little bit more skeptic. They pulled back a little bit. The industry shrunk from $6.8 trillion to $6.4 trillion by 2002. This kind of goes to the phrase I mentioned earlier about rising tides raise all boats. So if the overall market shrinks, or the economy starts to tank, financial services gets hit pretty hard. And that happened again from 2007 to 2010. And don't focus on this homework, because that's not going to be assigned to you guys. That was Chapter 2. Thanks, and we'll get started on Chapter 3 soon.